Hello and welcome to FX Street Currency in Play. I'm Matt Brown, coming to you from the heart of London from Core Finance. I'm joined today by Mark Oswald, who is a strategist at ADM Investor Services. How are you today, Mark?
I'm very well, thank you.
Good. Well, at the business end of the week, regards to macro data coming out, has it been a busy week though in the markets?
It's been occasionally choppy, but you definitely feel the sense that there's a lot of summer doldrums about, and even in equity markets, these little new highs that we get on the Dow, a lot of people are just going, well, yes, a new high which is plus 1 point or 2 points relative to yesterday is hardly going to get me particularly excited, and I think that's where we're at the moment. There is really quite a lot of summer lull. I think a lot of people would like a shock. They would like something to really shake this around, but at the moment they're hoping that it'll be payrolls today, and on the payroll side, it's going to be the payrolls number is probably not as important as it used to be. People are expecting a solid number. I think the whisper on the street is probably a lot stronger than the 180,000 medium forecast, probably something closer to 200,000 with hopes that the previous months will be revised upwards. But with markets being very skeptical on where the Fed goes from here, partly because of the political situation, what they really want to see is above expectations average hourly earnings number, because if it does come in at the 0.3, which is actually a respectable growth rate in month-on-month terms, it would still dip down to 2.4 in year-on-year terms. And a lot of people will say, well, what did we say? Why do they need to hike rates when average hourly earnings are down here and you got inflation around 1.5%? So that is the one which really needs to be watched and is needed to sort of jar the current sort of doldrums and complacency that there is in markets at the moment.
Good stuff. Well, let's have a look at the headlines, and I'm sure that will be echoed in the top trends that we're seeing. Dollar weakness persists ahead of payrolls. Euro dollar just below the 119. I mean, it's had a steady rise up, as we've talked many times on this show. Do you think the dollar is overextended now?
I think if you looked at it purely from the commitment of traders on IMM, the dollar, we are at peak levels, which frequently in the past, when we got this short of the dollar, have marked a turn in the trend. And with euro dollar, you're also looking at the fact that there really hasn't been a correction. This has been a relentless rise from 112 to 119. And as much as I can see the arguments that in terms of fair value, 120 minimum, perhaps 125 looks feasible. I think that's more of a medium-term objective than a short-term one. A short-term one, I think where we are vulnerable is, first of all, yes, the German-US yield spreads has narrowed, but not much recently. But it's still enormous, and it's much more in favour of the dollar than the euro. Secondly, I suppose the key here is really going to be we're all gloom and doom about the US economy, we're gloom and doom about the Trump presidency, having come into the year with so much optimism about the Trump bump, the Trumpflation trade, and all of that has gone up in a puff of smoke and generated a lot of this bearishness. But there's a point at where you just go, well, haven't we got all that priced in? And I think in the very short term, we're probably vulnerable to some better news, whether it's economic news or indeed on the political side. Say Congress actually starts to realize that with Trump mired in legal cases and all the stuff surrounding him and his relationships with Russia, perhaps Congress on a bipartisan level can actually start to do something in the way it hasn't done for about 10 years. And that, I think, is definitely not discounted in the dollar. If you were to see, say, some form of reconciled tax cut or some form of Healthcare Act reform, suddenly people would think, hold on a minute, maybe the US isn't completely mired in gridlock.
And today, if we see a stronger non-farm payroll number, do you think that euro-dollar trade could unwind?
To a certain extent, it really is going to be, it depends what the news flow on relating to Trump is going to be. There seems to be hotting up quite a lot now surrounding what Mr. Mueller is going to try and do. So it really depends on, it's going to have to be a big number. It has to be a big beat, really, to jar the political concerns.
Understood. And yesterday, obviously, the Bank of England, if we just look at cable and that sell-off that we saw in cable, sterling had a strong move above the 132 level over recent sessions. Just talk us through your thinking of why sterling sold off yesterday.
Well, I think that, first of all, markets were hoping that maybe Andy Haldane or someone else on the committee was going to vote for a rate hike, thus signalling that we are probably not that far away from a rate hike. Instead, it was 6.2. They cut their they shaved their GDP forecast, one should say. The way, if you read it about in the media today, you would think that they're suddenly forecasting recession, which is certainly something they're not doing. And indeed, it also misses the point that despite cutting their GDP forecasts, they kept their CPI forecasts the same, and they were actually trying to say, yes, in the next 6 months, maybe we're going to go through a period of negative real earnings, which is obviously not a positive, and slightly weaker growth, but they see things improving next year, and they were trying to sound quite upbeat. And indeed, Mr. Carney, in his comments, and I think this is the key here, was basically saying, look, it would only require a small improvement in the GDP outlook before we actually had to go, right, let's move now. Yeah. But in the short term, people were hoping for something which was less dovish than that appeared to be yesterday. And with sterling at these sort of levels, and one has to remember, sterling's actually only got to these levels against the dollar because of the dollar weakness. It's not sterling's strength. And so there is some vulnerability there, particularly if we saw a better number out of the States today.
And ahead of that number, would you have a trade on?
I think the trade I'd be looking at is to, if you are long of whether it's yen, sterling, euros, you should be starting to think about whether you want to take some profits on here, because I think that's where the vulnerability is. And particularly things like the Aussie dollar that you've got down there. For all that the RBA was upbeat on consumer spending, it was actually quite downbeat on the unemployment situation improving. And the message has been really, really clear from Governor Lowe and from Deputy Governor DeBell. Look, they don't see any reason for them to basically move off the neutral stance. So pushing up above that 80 level is going to require some sort of change in stance from them, particularly as at the moment they've revived the old protest about Australian dollar strength and the damage it could potentially do to the Australian economy. So as much as I can get it on the back of the stronger commodity prices that we've seen, particularly in the metals area, maybe at the moment that's another one where the carry is at least there in the trade, but I just wonder whether we can really generate the momentum for a serious break of 80.
Understood. Now let's have a look at the calendar. Obviously we've focused in on non-farm payrolls, so we won't go over that again. Trade balance as well, that may get some focus, but I think the key headline is non-farm. But loony traders.
Yes, that's going to be important. The loonies started to come off this week, and it did have a relentless run up to that 125 level. And if the unemployment data, we've had 2 strong months, so there is a bit of a vulnerability here that it may not actually be indicative of a weak labour market. But say you got a negative number on the employment, which is expected to be plus 10,000, that would probably be an excuse for further profit taking on those long loony trades.
And just at the bottom there, Baker Hughes rig count obviously for oil traders. Just to round up then, so potentially your trade for the day would be take profits if you have against the dollar, expect maybe a stronger number.
Yeah.
Have you got a number in mind?
I think what you'd need on payrolls is something like 220 and hopefully a 0.4 on average hourly earnings, and that would probably be enough to turn things around a bit, at least to generate some profit taking.
Fantastic. Mark Oswald, thank you very much for joining us today.